I think this quarter we saw a very disruptive sort of an event that happened in the middle of July, while banks were preparing for rates to merrily go downwards and had built up large bond books so that they could make large gains out of those. The powers that be actually raised rates by the sharpest I've ever seen on an overnight basis by 3%. So I think that event has dominated what has happened in the quarter in terms of portfolio gains and losses, also in terms of the cost of deposits and therefore repricing of the balance sheet on both sides of the balance sheet. So I think the major questions that are being asked or that have been asked of us, and we'll try to answer some of those questions, are how did you cope? How did you keep your net interest margins? Number one. Number two, what did you do with the mark-to-market losses on your this thing? How did your fee income keep growing? And then, of course, finally, a question that is always asked: how is the quality of your book, and what is the cost of credit that you're using? So we'll address all these questions, but I think overall we have got all lines going almost at the same speed as we've seen in the last 21 quarters. So the first line, revenue line, is always the interest income, net interest income. Net interest income in our case grew 37% year on year, but people watch quarter on quarter as well, and quarter on quarter also I think we were able to grow this by 3%. So on both sides, whether it's NII on year on year or quarter on quarter, we grew our interest income. The next big line for us is what we call core fee income, and that's the income that we actually earn from customers. That is the stable part of our income. And then there, of course, there is the total income, which includes the trading part of the income. So we'll show you both these numbers as well. Core fee income also grew by 32%. 32% year on year, and also grew by, I think, 3% quarter on quarter. So that part also operated well. What did not grow, of course, was the other income other than the core fee income, which is where the whole issue of this mark-to-markets came out. Net profit has grown overall by 32%. And is flat quarter on quarter, almost flat quarter on quarter. So that is the part that we need to explain, and that's why I'll get to explaining what. So that's the interest income. Interest income therefore kept pace. We grew 37%. The other part is the mark-to-market losses. I think that's a question that's going to be asked across the whole industry. So as far as we are concerned, we don't have any significant size corporate bond book. So whatever bonds we work on are government securities. So this bond book was 5,000 crores in quarter one. And in quarter one, we sold half this book already. So before all mayhem broke loose, we booked a nice profit in quarter one. You are all aware of the quarter one numbers. Quarter one trading profit therefore went to as high as 105 crores. This quarter, even after absorbing the mark-to-market losses, we have shown a trading income of 25 crores. So that's an 80 crore differential in the trading income. As you know, last year we conservatively provided a floating provision of 50 crores. So if we were to actually normalize for all that, our profit should actually have been higher by another 30 crores. That's the mark-to-market impact that has happened. So we have, in the SEBI note, you'll find a note which actually clarifies how much we have provided on the AFS and HFT. So there are two elements on the mark-to-market that we have taken. And in spite of those two elements, we have shown a 32% growth in the profit. One element relates to the government securities book, which is what they call the AFS and HFT book, on which together we took this thing of about 15 crores. And of course there is also a a swap book, which is a derivative book on which we took a mark-to-market of 27 crores. Overall, I think we have taken a mark-to-market loss, which we have built into this year's results at about around 50 crores. So in spite of that, we have shown the 32% increase in our net profit. Interest margin is the next question. So there was a lot of speculation on what will happen to banks which are bulk funded. That happens every 12 or 15 months. I have seen it happen thrice during the last 5.5 years. Whenever there's a liquidity crisis, they say, oh, what will happen to those banks which are bulk funded? And I think we have demonstrated time and again that in spite of being bulk funded to the extent of, say, 35% of our total funding base, we manage our margins quite efficiently. So even in the last cycle, when we saw over a period of 12 months margins contract, we recovered our margins back by 50 basis points in 2 quarters. So there's a very marginal movement in our NIM, which is down from 3.72 to 3.65. So it's a 7 basis points this thing, and I think this disproves that theory that bulk funding by itself is an evil. It's not bulk funding which is an evil. It's how you use that bulk funding that can really cause a problem in your balance sheet. So we use our bulk funding for financing short-term loans, which is our corporate bank. Our corporate bank maturity profile of our lending book matches the maturity profile of our bulk deposits, and we use CASA and long-term funding for our other book, which is our vehicle finance book. So net interest margin, therefore, has not shown much movement. We had anticipated that this quarter there will be a further hike in the cost of deposits, but things have turned suddenly, and I think CD rates have fallen off by a very significant amount, almost 150 basis points. And of course today's inflation numbers may point otherwise, but overall we believe that rates have peaked on the deposit side, and we'll only see an improvement in the cost of deposits, and therefore there should be an improvement in the next couple of quarters also on our net interest margin.